I'm joined today by Rob Sykes, Director of Advisory at WATG. Rob, thanks very much for joining us. Let's start just by telling us a little bit about the company and the strategy.
Hi, Richard. WATG is approaching its 80th year in the hospitality industry and has the enviable position of being arguably the most prolific specialist hospitality design firm. So our expertise ranges all the way through advisory, which is, as you say, the team that I'm leading, through to master planning, architecture, landscape design, and interior design. And my team at the advisory unit is often the first stepping stone in the process. So when a client comes to WATG with a piece of land, with their own vision, we help them evolve that, setting forth what we'd call a development brief for the project, which would then feed into the work that our colleagues in the master planning and architecture studios would use as their jumping off point.
There's been a big focus on residential in the markets at the moment, but also hospitality and hotels has been making a significant comeback in terms of both the market as well as investor intentions. It would be interesting just to pick up on the sort of concept of branded residential, where those two meet, I suppose. Just highlight a little bit, I guess, some of the challenges there and what you're seeing in terms of the market and opportunities.
Hospitality is definitely having a moment. And within the hospitality sector, specifically, the world of resorts and leisure travel, as it's taking some time for corporate travel to bounce back post-COVID. Leisure travel and the so-called revenge travel has really continued unabated. So we've seen fantastic operating performance across the resort sectors globally. And clearly investors are looking at that and starting to get more and more involved. So we're working increasingly with private equity funds, sovereign wealth, institutional funds who are increasingly receptive to exploring opportunities to invest in resort projects, which is really accelerating the growth of the sector globally. Within that, branded residences plays a key role. There's always trends and cyclical events in our industry, and for many years, wellness was having its moment. The last 10 years, people have been talking about lifestyle hotels, and more recently, branded residences is a growing phenomenon. We've seen almost a perfect storm of market conditions, evolution of the approach that hotel operators are taking to projects through management agreements rather than owning their own assets. We're seeing consumers becoming more and more convinced that this is an interesting investment model. And clearly for developers, there's a very strong economic rationale for exploring branded residential development, which is why so many of our clients are saying, yes, we want to develop an exceptional hotel, but we really need to understand how we can leverage branded residences to really amplify the appeal of our project and ultimately the economics of it. So I find we're in a really interesting position where the industry is now moving through this evolution where wellness remains incredibly important in terms of more holistic, nature-based wellness, all the way through to more clinical medical wellness at the other end. And then, as I said, the trend of lifestyle hotels. And what does that mean for branded residences, which are, by definition, a certain style of living?
We've talked a bit about why there's potential in the asset class, but is it something that should be treated as a hospitality product, or is this more of a hybrid blend of residential and hospitality? What is it that is going to drive success in this market?
If we go back in time, branded residences in their origins in North America was very much about owning a trophy asset. It may have been a primary residence, but more often a second, third, or fourth residence, and very much grand, large units. They were scarce in number and very high value. The way that the industry is evolving in the last 5 or 10 years and is going to evolve in the next 5 or 10 years is seeing a more varied typology, and particularly in a resort context, the role of rental pools and rental programs rising in prominence. And as such, it becomes more of a hospitality product. We need to understand all of the nuances that brings, whether it's servicing, operations. How do we manage to give residential owners and occupants access to the hotel's amenities versus building their own standalone facilities? So we really need to look at these co-located hotels and branded residences as one picture. So on project by project, it's a different answer. In certain locations, exclusivity, privacy, and independence reign supreme. In other locations, it's much more a seamless, fluid hospitality product.
And is your sense, Rob, that the operators really understand this model, and the opportunity is matched, I suppose, by the understanding in the market of the opportunities here?
Increasingly so, but not always the case. I mean, there were certain brands, to name a few, Four Seasons, Marriott International with Ritz-Carlton, were leading the way for many, many years. So inevitably, the level of expertise and knowledge they have of how to structure these types of projects was a little bit more advanced. But in recent years, a lot of the operators have been really catching up. The hospitality development teams within a lot of these brands are upskilling in terms of being able to talk the talk and walk the walk in terms of residential as well as the hospitality play. So I think that is going to really help the more seamless rollout of branded residential projects in coming years. And I think it's clear just looking at the data that the hotel operators are all receptive to this new model, this new genre of hospitality development. Looking at the pipeline of projects globally versus the open stock, we're looking at a pipeline that's around 150% of the existing stock. And in Europe, it's even more, starting from a low base, but we're looking at more like 325 to 350% pipeline versus existing stock. In the next 5 years, it's likely that globally the number of branded residences in the market will double on what there is today. So that clearly shows that it's not just developers, but also operators who are putting their momentum behind this model. But it wouldn't be sustainable if it wasn't for consumer demand. There's a lot of evidence from active projects that there is appetite for this asset class. People are willing to pay a premium for this product because of the security in the investment, the potential for returns if there's a rental program, long-term capital appreciation, but ultimately that security blanket that the brand and the operator gives, that you know that when you're not in residence, your property is going to be well maintained, well looked after, and when you do come to use it, it will be in impeccable condition. So there's a reduction of risk, a perception of risk for the owners as well.
Really interesting to catch up on this area, Rob. And it sounds as though, particularly for Europe, it's one to watch going forward. Thanks very much for joining us.
You're very welcome.